As we continue our discussion, let's see how we can choose portfolios. So let's think portfolio risk and return. We want to create an investment portfolio. There are two tasks. The first task is we really need to figure out what our asset allocation should be. This is the proportion of the portfolio that we invest in each asset. Then we go to security selection. We select those assets within the asset classes that we want in our portfolio. So asset allocation is the decision of how you split your investment dollars between asset classes. So creating a portfolio involves selecting those securities and how much to invest in each. Portfolio return is the weighted average of the return of the assets. So if you had 50% in Tesla, that has a 12% expected return, and 50% in Amazon, that has a 10% expected return, your portfolio's expected return would be roughly 11%. It's the weighted average of the returns within the portfolio. To find risk is a little more complicated. It depends not on just the individual assets risk, but also on correlations. As you see our formula here, correlation is an important part of the second component of our formula. If that is negative, then all of these other variables are also then positive, right? Standard deviation has to be positive. Right now, we haven't introduced any negative weights. So right now, we say that the weights, since these are square roots, these are positive. This number, if it is negative, then it reduces the amount of risk. That's where the diversification comes from. So if we can combine some volatile tech stocks with stable utilities, that's going to reduce the overall risk thanks to their differing performance patterns. So here we have three different kinds of portfolios with three assets. We have 8.3%, 10.6%, and 12.3% is the returns of those stocks. If we put them into portfolios, portfolio one, we have 50% in each one. So the formula, 50% of 8.3 plus 50% of 10.6 gets us 9.45%. So the difference between portfolios 1 and 2 is we have different assets. Obviously provides different returns. The difference between portfolios 2 and 3 is we have the same assets, but we have different weights. So there are two different kinds of investment strategies with two assets. We can invest in two assets, or we can differ the weights within those portfolios. Looking at these three assets then, and now their risk levels, we have the standard deviations for the three assets, 15.2, 21.7, 2.93. We also have the correlations between these assets. So earlier we found the returns of each portfolio. So here is the standard deviation for portfolio 1 that had 50% in A, 50% in B. We would end up with the 15.8% standard deviation for that particular portfolio. If we look at how this works in a spreadsheet, here we have 50% in each asset. Here's the variance of each asset and its standard deviation. Here's the correlation. So our ultimate standard deviation here, 15.8%, and this portfolio should average around a 9.45% rate of return. Now there's a lot more going on in this slide than we really need to know for this example, but this talks about or helps us to view what happens as we change weights and how that impacts risk and return. when we put these three portfolios together, what do we notice? We notice that portfolio 2 has the highest return, 18.2%. Asset 3 is second highest, but has a lower risk level. It has less risk than the other two portfolios. 9.45 for portfolio 1 has a little bit more risk than 3. So what we would say here is that 3 is probably the better portfolio. Certainly it's better than 1 because it has a higher rate of return and it has a lower level of risk. Now, when we're looking at 2 and 3, it's a little bit tougher to make the choice. But if you look at it, it has a 0.8% higher risk or return, excuse me, but it has 2.7% higher rate of risk. So for a little bit of an increase in return, it has a substantial increase in risk. So we still might say that 3 might be the dominant portfolio. Now that doesn't mean that you're necessarily going to pick that one. It just says that one appears to be what gives us the best risk-return relationship. To see how adding stock reduces risk, we have a slide that shows, stock Z here has a risk of roughly about 8%. If we add stock Y to that has a standard deviation of 8.5, just by adding the two together, we get reduced risk. And so on and so on. As we continue to add stocks, ultimately, if we got to add 500 stocks here and the S&P 500 index, we would find that that has this minimum level of risk. What they're trying to show here, and I don't think this graph does it justice, it shows that as we add stocks, we see risk reduce. And sooner or later, if we get enough stocks, the reduction of risk we just don't get the same benefit as we add more and more and more things together. There's a limit to this. I particularly like this graph a little bit better because it gives us a description, if you will, of the two different kinds of risk. We know that there is diversifiable risk and there's non-diversifiable or market risk. The total risk of a portfolio is this blue line. And as you see, as we add more and more stocks, total risk goes down. So what is disappearing here? What is it that's being eliminated? It's this diversifiable risk piece. But once we get down to 20, 30, 40 stocks down here, adding more stocks does not dramatically reduce the risk at some point. So adding stocks brings down risk, but there's still risk. Systematic risk, that's the risk that's inherent to the overall market. This is undiversifiable. You cannot get rid of it. So there are two types. Systematic risk, things like recessions, affect the entire market. Unsystematic risk, like a CEO scandal, might only impact a few companies. It cannot, and that therefore we can, when we average it, we're diversifying it away. However, even a well-diversified portfolio is exposed to market risk. That's the risk associated, again, with macroeconomic factors. And that's why a diversified portfolio still reacts to major market downturns, such as the 2008 financial crisis or the pandemic crisis. So a practical lesson here is that diversification works best when investors combine stocks with low or negative correlations, and when they accept that some market risk is inevitable. So here we look at some asset classes, if you will. We're really looking at stock market. So we have 6 different stock markets that we can review, and we also have 2 categories of debt: long-term treasury bonds and 3-month T-bills. So this group activity asks us to calculate the portfolio risk and return for a particular asset. So I went to a spreadsheet because the math is a little bit messy to do by hand. And this is the risk and return, calculate the risk and return worksheet. But I have equally weighted for 4 assets: the S&P 500, long-term treasury bonds, the German exchange, the DAX performance exchange, and the Nikkei. I have their returns, their variance. I have input their correlations into the table. So a equally weighted portfolio would give us a return of a roughly 0.45% return per month. And the standard deviation of that is 4.52%. Another thing that I did here is I says, well, what would give me the lowest return? What if I just put 50% in asset A and 50% in asset B, which is stock and bond? What would that give me? In this case, 0.49%, not much of a higher rate of return than that, and 2.15%. So this portfolio gives me slightly higher returns and much less risk. This portfolio of 50-50 is dominant to this portfolio that's equally weighted. So again, the goal is to kind of figure out how do we want to invest. So imagine these are all the individual stocks that we can purchase. This is our stock universe, or our investment choices, if you will, right? As investors, again, we always want more returns, but now we know that might also mean more risk. So how do we choose? There are techniques to analyze this, but in the end, personal experience and preferences will drive us to a certain investment. So this aspect of finance is also kind of referred to as behavioral finance. But let's look at assets W and Z. If you notice, they are relatively almost the exact same return, but W has much less risk than Z. So W is a better investment than Z is. What about T and V? Again, if you look, T has a much higher return, but it's just slightly more risky than V. So again, although it's not a strict domination, it's really a much better investment than V in the long run. What happens when we create these portfolios? Again, remember that these blue dots represent those individual stocks. Now the gold or the green dots here represent portfolios. And just to show you what we might look at is if you have this portfolio that has W, X, Y, and Z in it, that portfolio dominates W. That portfolio is better because it has higher return and it also has the same amount of risk, but it has higher returns. So what we ultimately want to try to create is a picture, if you will, of what are the best stocks of this, what are the best combinations that we can get for these particular investments. The minimum variance portfolio is a starting point. This is the portfolio that has the lowest risk as measured by variance or standard deviation. So what we can see here is all these portfolios, this one right here, TUVWXYZ, that includes all of them. That portfolio has the least amount of risk possible of all of our choices. So the minimum variance portfolio describes a combination of assets that give the least risk. This is the starting point in developing a portfolio. It states that given all the assets available, you cannot get a portfolio with less risk. That will help us create the ongoing picture of what we should invest in. So modern portfolio theory identifies efficient portfolios. These have the highest rates of return for given levels of risk. For example, if you're deciding between a risky biotech stock and a blue chip stock, this theory helps you find the best combination of those two investments. So an investment portfolio describes a portfolio where you cannot find an asset, a portfolio of assets with higher levels of return at any level of risk. If you look at the medium risk portfolio here, we're looking at a graph that has approximately 6.25% in standard deviation, roughly 2.75% return. You cannot get another investment with higher than 2.75% return and have a 6.25% risk level. The minimum risk portfolio here is around 4.25% standard deviation and slightly less than 1.5% return. So the moral of the story is the only investments here we should be looking at are those assets that are on this curve. They represent those choices that are the highest risk, highest return levels at these risk levels, under the assumption that we cannot get less than 4.25. Again, the moral of the story is that the only investments we should look at are those on the curve. Now, depending on the risk we choose, that will tell us which portfolio we want.